What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the worst sell-off in the bond market in the US's history. It's the second longest bear market for the bond market here in the US's history. So lots to discuss. And we're also going to talk a little bit about how the conflict in the Middle East is shifting the Federal Reserve's interest rate expectations from the market and where we are in terms of those probabilities. So as always, if you enjoyed this video, find it helpful, please make sure to drop a like. That's all I'm asking in return. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only private videos, trading view charts. There's going to be individual stock reports. I opened up a couple more spots. So if you're interested in joining, link's going to be down below and we'd love to have you on board. So first things first, let's talk a little bit about the greatest treasury bear market of all time. This is by far the biggest sell-off that we have seen in the bond market over the last 3 years. So what you'll notice is the treasury debt losses over the past 3 years have amounted to the worst bear market in nearly 250-year history of the US. And these right here are some of the charts that basically suggest that this 24.7% sell-off from top to bottom. So if you come over to, something as simple as TLT, you'll notice that it's been on a consistent decline lower, and from its 2020 highs, it is down over 49%. But of course, from its beginning of 2020 levels, it is down a little bit close to 29%. So absolutely brutal market sell-off since July 2020 to where we are now. And this has also been the second longest bear market for the bond market. So 1835, 56 months. Can you believe that? 56 months. The bond market was down between 1835 and 1839. So that 4-year period, the market continued to sell off, but it wasn't as severe as what we witnessed in 1861. It was only 1 year long, so only 12 months long, when the bond market was down almost 19%. And this is the most brutal sell-off and the second longest lasting bear market for the bonds here. 28 months and a 24.7% sell-off, and there hasn't been any recovery on a 1 year basis from the trough. It's literally at its lowest level that we've seen, especially if you come over to some of the more levered ETFs, like for example TMF. It's at an all-time low, right? It hasn't been this low ever. And from $55, the stock, this one is down over 92%, right? Why? Because yields continue to push higher, continue to put pressure on the market. This right here, U.S. Treasury is oversold again. So U.S. Treasury price versus 200-day moving averages, and what we have witnessed is, they were almost identical in October 2022, March 21, December 2016, June 09. We got June 99, May 94, October 90, and October 87 as well. Now, one thing I want to point out is that this still doesn't necessarily mean the markets can't go any lower, because if you come over to TLT, what you'll notice is that in June of 2022, right? So if you come over to June through October 2022, the markets were indeed oversold, but we didn't quite see we saw like a, reasonable push higher of about 15-16%, but that didn't necessarily mean that we saw a reversal, or that was kind of like the bottoms in and we're going to start seeing some momentum back up, because since then the markets have rolled over even more. They dropped another 20% from those October, November highs from last year. So just because, this chart suggests that we are oversold and, they're trading below their 200 simple moving average, a couple of standard deviations away from its 200 SMAs, doesn't mean that this is going to start a recovery, that this is going to indeed be the bottom. But if anything, it could be a more of a technical rebound possibility for the market, for the bond market specifically, and for the yields coming down. So for those reasons, obviously I've been slowly and steadily kind of building that position in TMF. I did buy a little bit last week, I think, and we'll be looking at picking up more shares as we continue to see this oversold levels in the bond market. Now, there's many times a few things happen for the first time. So a lot of people would, think that this time is indeed different. And I don't blame them, because, the amount of the sheer sell-off that we've seen in the bond market, not to mention the longer lasting it's been, it's very normal to expect that this time is indeed different, meaning that this time's sell-off is going to stay and it's not going to recover. It's very easy to believe that. But yields, I guess there is a macro angle to this as well, because we know the debt levels have only gotten worse. We're dealing with fiscal deficit risk. We're dealing with a lot of uncertainty around the credit ratings and the level of debt and the geopolitical tensions, which is what's causing yields to continue to go up. And we haven't really seen this type of environment in the past. Maybe we have, maybe we haven't, but the bottom line is that just because the markets are oversold doesn't give us any indication that this is indeed the bottom and we need to start buying. Or if the yields continue to push higher, that doesn't tell us that eventually they're going to come down, right? There's a lot of uncertainty around that, and that's exactly why I want you guys to take it slow and steady, because even some of the bigger banks, right? It's not just us. Even some of the bigger banks are holding to hold to maturity bond book is seeing huge paper losses, and not to mention a lot of other banks that are holding on to worth over $600 billion worth of losses, unrealized losses on their books, right? Those are pretty substantial numbers. This right here is another report that came out today. So the conflict could change what the Federal Reserve does about interest rates. So this was Randall Stephenson, head of investment banking at FE International, says, and I quote, "It's too early to say whether the knee-jerk reactions seen in the markets on Monday are going to be maintained or accelerate. It depends on how quickly and how far this conflict expands." So if you come over to what the treasury market's kind of pricing in now, or the market's pricing in for Federal Reserve's interest rates, 86% probability that the Federal Reserve is going to keep interest rates steady and sooner cuts. Earlier, it was up until July, and now we're expecting cuts starting June, so right after May. And the probability for December is also pushed back up to a pause at 72.4%. So 86.4, 72.4, 68.5. So the market's pretty determined and fully on board with the potential pause from the Federal Reserve, and they're not expecting any more hikes anymore. And that's all because of the conflict and the possibility that they could expand to other parts of the global economy. And if it does, that's going to create some more burden, some more stress in the system, which is exactly what the Federal Reserve is trying to both manifest and at the same time avoid. It's kind of like a weird situation because the Federal Reserve wants the labor market to weaken, but at the same time, they don't want it to be so weak that it causes a recession, right? So they're kind of walking this very fine line where, yes, we want the economy to slow down. Yes, we want the labor market to show signs of weakness, but only to a certain extent, right? They don't want to go past that because then it'll cause a recession. So they're kind of following a very, very fine line with respect to the economy and the labor market. So, do I agree with these interest rate projections? No, because I still expect the Federal Reserve is not done yet because of everything that's going on with the labor market being so tight. Of course, we'll get the inflation numbers on Thursday, but the bottom line is, economy is incredibly strong, labor market's incredibly strong, inflation is somewhat persistently elevated, and it's accelerating on the headline basis. So when you put those pieces together, I still am not fully on board with the possibility the Federal Reserve is not going to hike anymore when majority of FOMC members have penciled in a possibility for a rate hike. So let me know in the comment section below, what do you think about interest rates, and are you expecting another hike or no hike, pause, cut? Let us know in the comment section down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below. We'd love to have you on board as a MoneyVest member. Happy investing, and I'll see you all in the next video.